You stand at the bottom of your mountain on a perfect January morning. Fresh snow covers every run. The parking lots are filling. A line is forming at the ticket window, where a family may spend hundreds of dollars before renting a single pair of skis or buying lunch. Chairlifts carry paying customers uphill, gravity brings them back down, and the snow itself appears to have arrived free of charge. From the outside, owning a ski resort can look almost unfairly attractive. You control access to a mountain. Customers pay premium prices to use it. Food is expensive. Lessons are expensive. Rentals are expensive. And on the busiest days, thousands of people willingly wait in line for the privilege of spending even more. But the mountain is not the business advantage it appears to be. It is the source of the business's biggest risk. A ski resort must build and maintain an expensive industrial system around a product it cannot fully control, then recover most of its annual cost during a short season whose beginning, ending, and quality are partly decided by weather. That creates the central contradiction of ski resort ownership. The resort may own the lifts, buildings, and equipment, but it does not own winter. And the entire business is an attempt to solve that problem. Start with the calendar. A hotel in a major city can sell rooms throughout the year. A supermarket can trade every week. A ski resort may operate some summer attractions, but its defining product is concentrated into a limited winter window. Within that window, not all days are equal. Christmas and New Year, school holidays, President's Day weekend in the United States, and other peak travel periods can account for an unusually important share of visits and spending. A storm arriving on a quiet Tuesday in March is useful. Snow arriving before the Christmas holidays can determine whether families keep expensive reservations, whether lessons remain booked, and whether restaurants fill during one of the most valuable periods of the season. That is why the opening date matters so much. The resort does not merely need snowfall eventually. It needs enough terrain available at the moment customers are ready to travel. A mountain can finish the winter with respectable total snowfall and still experience a financially painful season if the snow arrives late, melts during key holidays, or repeatedly falls as rain at lower elevations. The product is timing. And timing cannot be stored for next year. A manufacturer can sometimes carry unsold inventory into a later quarter. An empty chairlift seat on December 28th disappears forever. So does the unbooked hotel room, the unused rental equipment, and the instructor hour that was never sold. This makes ski capacity perishable. Once the day ends, the resort can never sell that day again. That would be difficult enough if the mountain were cheap to operate. It is not. Before a customer reaches the summit, the owner needs lifts. A modern detachable chairlift or gondola is not simply a long cable with seats attached. It is transportation infrastructure involving towers, terminals, motors, braking systems, controls, evacuation procedures, and constant inspection. Even older lifts require skilled maintenance. Components wear. Cables, grips, bearings, electrical systems, and safety equipment need attention. At some point, an aging lift may require a major rebuild or complete replacement. That investment can be necessary even when the existing lift still technically works. Customers compare speed, comfort, and reliability. A slow chairlift reduces the amount of skiing they receive in a day. It also creates queues at the bottom, making the resort feel overcrowded without adding a single visitor. Then there are snowcats, the tracked grooming machines that reshape slopes after the mountain closes. Grooming makes runs safer and more predictable, moves snow into thin areas, and repairs the damage created by thousands of skiers. Those machines require operators, maintenance, and fuel. Much of this work happens overnight, when customers see none of it. The mountain looks natural in the morning because an industrial operation worked through the darkness, and when nature does not provide enough snow, the resort may have to manufacture it. Snowmaking sounds like a simple backup system. Spray water into cold air and allow it to freeze. Economically, it is closer to building an artificial winter factory across the side of a mountain. The resort needs access to water, pumps, pipes, compressors or fan guns, electrical infrastructure, storage ponds, and crews, capable of operating the system when temperatures permit. Cold matters because snowmaking does not depend only on the number shown by a standard thermometer. Operators also watch wet bulb temperature, which combines temperature and humidity. Drier air can allow snow production at somewhat warmer temperatures, while humid conditions make it more difficult. The owner therefore faces a particularly frustrating scenario. There may be no natural snow, but it may also be too warm or humid to make enough artificial snow efficiently. More equipment cannot completely solve that. Snowmaking provides control, not immunity. In parts of the northeastern United States, climate research has identified 3 conditions associated with ski area viability: a season around 100 days, sufficiently cold nights for snowmaking, and snow coverage during important winter holiday periods. Warmer conditions can increase the need for artificial snow while simultaneously reducing the hours during which it can be produced efficiently. Longer-term snow trends add another layer of uncertainty. Historical EPA data showed declining April snowpack at more than 90% of measured western U.S. sites between 1955 and 2016, with an average decline of roughly 23% across those sites. That does not mean every mountain or every season will receive less snow. It does mean resort owners cannot safely assume that historical operating conditions will remain unchanged. Now add labor. A ski resort may need lift operators, patrollers, instructors, snowmakers, groomers, mechanics, parking attendants, ticket staff, cooks, servers, rental technicians, housekeepers, shuttle drivers, and administrative employees. Many of these positions are seasonal. That sounds flexible, but seasonality creates its own problems. The resort has to recruit large numbers of workers for a limited period, often in mountain communities where housing is scarce and expensive. An employee earning a seasonal wage may be unable to live anywhere near the resort. The operator can raise wages, provide housing, run transportation, or accept chronic staffing shortages. Every option costs money. A lack of workers does not remain a human resources problem. It spreads into the customer experience. Fewer instructors mean fewer lessons. Fewer cooks mean reduced restaurant capacity. Fewer lift operators may limit which terrain can open. Insufficient housekeeping staff can prevent hotel rooms from being made available, even when demand exists. The mountain can have snow and customers and still leave revenue unused because it does not have enough people to operate the product. This is why the price printed on the ticket window can be misleading. At large destination resorts, the walk-up price for a one-day ticket can be extremely high. That creates the impression that each skier entering the mountain is generating that entire amount in revenue. Many are not. Some customers bought a season pass months earlier. Others purchased multi-day access, discount products, or group packages. Employees, partners, and promotional guests may ski under different arrangements. The resort's real lift revenue must be divided across the number of visits those products create. An unlimited pass holder who skis twice can be highly profitable. The same pass holder skiing 50 times produces far less lift revenue per visit. But that does not necessarily make the frequent skier a bad customer. They may buy food, rent equipment, place children in lessons, or bring friends who purchase full-price products. This is where the resort stops behaving like a simple ticket booth. The lift is the entry point into a much larger spending system. A first-time visitor may need skis, boots, poles, clothing, and instruction. A family may purchase 4 lift products, several days of rentals, and lessons for the children. A destination traveler may also need lodging, meals, airport transportation, and entertainment. The resort wants to capture as much of that journey as possible. Ski school can be especially valuable because instruction solves several problems at once. It generates direct revenue, makes beginners more likely to enjoy the sport, and can free parents to ski independently while children attend lessons. Rentals reduce the friction of ownership. Travelers avoid transporting large equipment, while beginners can participate without purchasing an expensive setup. Restaurants convert captive mountain traffic into food and beverage revenue. A skier halfway through the day cannot easily drive 20 minutes to find a cheaper lunch without sacrificing valuable slope time. Lodging turns a day visitor into a multi-day customer. Retail captures purchases ranging from gloves and goggles to branded clothing and replacement equipment. Parking can become a revenue source or a tool for controlling congestion. Premium parking creates a convenience product out of something that was once included. The most valuable part of the resort, therefore, may not be the activity that defines it. Skiing attracts the customer. Everything surrounding skiing determines how much the visit is worth. Public resort company results illustrate this structure. In fiscal 2025, Vail Resorts reported approximately $1.5 billion in total lift revenue, but also hundreds of millions from ski school, dining, retail, rentals, and lodging. When skier visits declined, some ancillary categories weakened, while increased spending per guest helped support others. That relationship matters because ancillary spending usually begins with one event. The customer arrives. No visit means no lesson, no rental, and no mountain lunch. And this is where a poor snow season turns into something more dangerous than a few lost ticket sales. The chain reaction often begins before opening day. Suppose early winter is unusually warm. Natural snowfall is limited, and snowmaking windows are short. The resort opens only a fraction of its terrain. Customers who have not yet committed delay their trips. Some cancel lodging. Others choose another mountain with better conditions. Lower visitation reduces lift ticket revenue, but it also reduces ski school bookings, rental transactions, restaurant sales, and retail purchases. The resort may respond by discounting rooms or lift products. That can protect volume, but each customer now produces less revenue. Meanwhile, many expenses remain. Snowmaking may intensify. Grooming continues. Lift maintenance has already been completed. Salaried employees, debt payments, insurance, and infrastructure costs do not disappear. The operator may reduce seasonal staffing or postpone opening certain lifts and restaurants. That saves money, but it also shrinks the experience. Fewer open runs concentrate skiers into smaller areas. Lines grow. Online complaints increase. Guests feel they paid too much for a partial product. Some decide not to return. A weather problem has now become a reputation problem. If the resort is highly leveraged, the next stage is a cash flow problem. The company entered winter expecting holiday revenue to replenish cash after months of off-season spending. When that revenue arrives late or below expectations, it may have to borrow more, delay investment, or renegotiate obligations. Delayed investment makes the resort less competitive. 1 week winter may be manageable. Several poorly timed winters, combined with debt and aging infrastructure, can push the property into a decline that becomes increasingly expensive to reverse. This explains the industry's most counterintuitive financial invention. The season pass is not merely a cheaper ticket, it is a tool for moving revenue to the opposite side of uncertainty. Traditionally, a resort waited for winter. Snow arrived, customers decided whether to visit, and the operator collected revenue when they appeared. Under an advance pass model, the customer pays before knowing exactly how much snow will fall, when terrain will open, or how many days they will personally ski. The resort receives cash earlier and gains visibility into demand. Part of the weather risk has moved. The customer is now the one hoping to get their money's worth. That shift became especially visible in March 2008 when Vail Resorts introduced the original Epic Season Pass for the 2008 to 2009 season. The initial adult price was $579 and provided unrestricted access to 5 Vail-operated resorts, with the company also describing access across 17,400 acres, 128 chairlifts, and 722 trails. The pass was non-refundable and had to be purchased by a November deadline. To skiers, the offer looked like a dramatic price reduction. Someone taking several trips could quickly make the pass cheaper than purchasing individual tickets. The customer gained flexibility across several mountains, including the ability to follow better snow conditions. But look at the transaction from the operator's side. Vail collected money before most of the ski season had begun. It secured a customer's loyalty before that customer chose where to take each trip. And because the pass worked across several resorts, weak snowfall at one location did not necessarily destroy the entire value proposition. A customer could travel to another mountain within the same network. That gave scale a new purpose. Acquiring additional resorts was not only about adding lift capacity. Each resort made the pass more valuable, and each pass holder became more likely to spend future lodging, dining, lesson, and rental dollars somewhere inside the network. The pass turned separate mountains into a connected platform. That is the hidden mechanism. The company was no longer selling only ski days. It was selling membership in a portfolio of possible ski days. Over time, prepaid access became increasingly important to Vail Resorts' financial model. Its public disclosures now track pass product sales months before the season begins because those sales provide an early view of both revenue and committed customers. In fiscal 2025, the company said season pass revenue increased even though skier visits across its North American properties declined. This does not eliminate weather risk. A pass holder may still visit less when conditions are poor, reducing spending on food, lessons, and rentals. Vail's own reporting shows that lower visitation can pressure those ancillary businesses even when advance pass revenue provides protection. The pass changes the shape of the risk. Without advance commitment, poor snow can damage both ticket sales and everything sold after arrival. With prepaid products, some lift revenue is protected, but the operator still needs customers to show up and spend. That is why a crowded-looking mountain can hide conflicting economics. Pass sales may be strong, providing stable cash flow. Yet excessive crowding can reduce customer satisfaction. Lift lines lengthen. Parking fills. Restaurants become overwhelmed. The pass that lowers demand uncertainty can create a capacity problem. The operator then has to invest in faster lifts, expanded terrain, reservations, parking systems, or staffing, not necessarily to attract more customers, but to prevent existing customers from feeling that the product has deteriorated. A larger customer base improves revenue predictability. It can also make the mountain harder to operate. This is the broader lesson from the Epic Pass case. The strongest adaptation to uncertain snow was not a better snow gun or a larger chairlift. It was a financial product that encouraged customers to commit before the weather was known. Competitors developed their own multi-resort products and partnerships, creating an industry in which many serious skiers choose a pass ecosystem before choosing individual trips. The decision happens earlier now, and once the customer has selected a pass, future vacation spending tends to follow that decision. So what does owning a successful ski resort actually look like? The spectacular best case is a major destination mountain with reliable access, strong snowmaking, differentiated terrain, premium lodging, and a recognized brand. It sells substantial pass volume before winter, attracts high-spending destination guests, and captures revenue from lessons, rentals, restaurants, retail, and accommodation. Summer activities provide additional revenue, while scale supports marketing, technology, and capital investment. But very few mountains become that. The realistic successful resort is more disciplined. It may serve a regional customer base, focus on weekends and school groups, operate efficient snowmaking, and keep debt within a level the normal season can support. It does not need to become famous. It needs to understand exactly who drives there, how often they visit, and how much infrastructure that demand can justify. A small resort with controlled costs can be healthier than a spectacular mountain built for customers who never arrive. The realistic negative outcome is a property that remains operational, but becomes trapped between rising costs and limited pricing power. It must make more snow, pay more for workers, and replace aging lifts, yet its customers resist higher prices or shift to larger pass networks. Maintenance is delayed. Terrain opens less consistently. The experience weakens gradually. The mountain still appears alive. Its future becomes narrower every year. In the failure scenario, debt and fixed costs were based on optimistic visitation. Then, poor holiday conditions, competition, or economic weakness reduces demand. Discounts protect traffic but damage margins. Staffing and maintenance cuts weaken service. The resort cannot finance upgrades, which makes it even less competitive. Eventually, the asset becomes worth less than the money invested in it. The mountain remains. The business around it does not. That is why owning a ski resort is not fundamentally about owning beautiful land or charging people to ride uphill. It is about coordinating transportation, hospitality, labor, weather forecasting, water, energy, and customer finance inside a business that gets only a limited number of chances each year to be right. Snowmaking reduces uncertainty. Diversification spreads revenue. Summer operations use assets longer. Lessons and rentals increase customer value. Multi-resort passes collect money early and encourage loyalty. But every solution introduces a new cost, dependency, or trade-off. The owner can influence winter, the owner cannot command it. So when a crowded ski slope looks like guaranteed profit, remember what is happening underneath. The resort has spent all year preparing for a season it cannot postpone, serving customers who can change plans faster than the mountain can change its cost structure. The snow may fall from the sky for free. Almost everything required to turn it into a business is expensive. A ski resort does not really sell snow. It sells confidence that winter will be worth paying for, often before winter has even arrived.